In this presentation, we're going to discuss sales tax with regards to our cash-based system. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. We're going to start off by opening up our reports once again. So we'll go to the reports at the bottom. We're going to be opening up the balance sheet. Within the balance sheet, going to be changing the dates up top. Those dates being January through, I'm going to make it through December, or let's make it through March 03/31/20. Run that report. Then I'm going to right click up top and I'm going to duplicate that tab back to the tab to the left, back to the reports at the bottom. Then we're going to be opening up the P&L, the profit and loss. So we're opening up the P&L. We're going to change the dates this time just for the month of March, that being 03/01/20 to 03/31/20. And then I'm going to run that report. I'm going to duplicate the tab, right click it on the tab up top to duplicate it. Then I'm going to close up the hamburger like so, hold down Control, scroll up a bit to get up to that 125. Now, we considered last time, we're saying that we're on a cash-based system and we're dealing with inventory, and that means we're subject to sales tax. So remember, if you had an invoice that you were going to create, there's multiple things that happen at the point in time that you make an invoice, including the creation of the sales tax. However, the way we're doing it on a cash-based system, we're kind of recording two components at different times of the sale of inventory. In other words, we're recording the cost of goods sold at the point in time we purchase it on a cash basis. And then instead of recording it at the point in time of the invoice, so we're not using the invoice to record cost of goods sold, we're doing it at the point in time we purchase it on a cash basis system. And then when we make the deposit, when we actually get to the deposit, we're assuming we're depositing things for inventory that was sold. And therefore, we're going to just wait till we get the deposit that goes into the bank statement, rely on the bank statement, increase in the deposit, and put in the other side to sales. However, you might say, well, what about sales tax? How does sales tax work into this kind of system? What if I'm subject to it? If you're not subject to sales tax, especially if you're not dealing with inventory and electronic payments and not invoicing, have no need for invoicing, then the cash system works very well. If you have more of these issues, then you could still kind of work it, but you can see it's a little bit more complex. You got to think about how it's going to fit in there. So the sales tax is kind of the missing component. So let's open this up. I'm going to change the dates to go back to 01/01/20 in this transaction detail report, and we'll actually pull up an invoice. So down here, we're working with deposits. Let's pull up an invoice and take a look at what an invoice looks like and what sales tax would be calculated on it. So if we see an invoice, you'll recall what happens when we make an invoice. It's going to increase accounts receivable at that point in time. It's going to increase sales, but AR is going to go up by the full amount, the $448.95 in this case. And the sales is only going to be going up by the $410. The difference is $38.95, which happens to be in California. There's a 9.5 if you put it all together, state and local sales tax that I'm currently using here. 9.5 sales tax is the difference. That shouldn't be going to sales. It should be increasing a liability. But if it increases a liability, once again, we're talking about an accrual system, and I'm on a cash system, so I don't want to be dealing with the liability here. So how can we do this on a cash basis? One way we can think about this is to work the sales tax into basically the sales price. So in other words, if I was to recreate this invoice, I could say it was $410 is our sales price, and then the state or the county or the local tough guy, whoever's strong-arming us for the 9.5% is what we got to pay them, right? Which is going to be the $38.95. That means our actual sales price is going to be the $448.95. So the $448.95. So we're going to assume then that our sales is at the $448.95. Now, if we were to reverse engineer this and think about, well, what if I think about my sales price and then back into this $38.95? What we can do is just copy this same thing. I'm going to do this in Excel with a little feature that I like to point out every once in a while. We could say, okay, well, what if I have basically the end number, this 448.95, and we could use some algebra to kind of back into to get back to the 410, or we could use basically Excel. We could use the same formula. Notice I still have the formulas here, but they're at 0 to figure out what this cell should be. So I'm going to put my cursor off of this cell, and I'm going to go to the Data tab. To do this, I'm going to go to the Forecast. I'm going to go to the What If analysis. then I'm going to go to goal seek. So I'm going to go to goal seek and I'm going to ask Excel. I'm going to say, hey, Excel, I'd like you to set this cell to equal the value of what we know it should be, or our end value of 448.95 by changing this cell. So and then Excel's just going to basically try every number that it can until it's just going to do trial and error until it finds the right number up top. So we're going to say, hey, Excel, once again, I'd like you to set this cell to be what we know it should be, 44895, by changing this cell up top. Because they're all connected through formulas, Excel can then just do trial and error to find that number. So there it is, and we're going to get to that 410. So if we use that method, and we go back here, and I say, all right, so notice I kind of backed into this number. So we said that, here's our ending number. We backed into the beginning number and then the sales tax. Now, if I made multiple sales in that method, so if I close this back out and I go back up top and I say just for the month of March, 0301 20 to 0331 20, and we run that report, and we say, okay, here's the sales that happened for all of March. And if I had already included the sales tax in here, this would be included in the sales tax. Or if the state or the local tough guy or whoever's strong arming us is telling us, hey, you got to pay me, the 9.5%, then we have to back out the 9.5% out of the sales price at that point, right? So we're going to say, all right, let's do that. We're going to do that and say that this then, if we do the same kind of scenario, adds up to a total of the 21,630. So the 21,630 is going to, so I'm going to type that down below here, 21630. That's what this ending number should be after we do our calculation. We're going to change this number up top. That's the unknown, right? And so we're going to use the same formula. I'm going to use the same goal seek, and this is going to include multiple sales, and we're going to take out 9.5% of, the total sales that we have made. So then we go to the data tab. We're going to go to the forecasting what if analysis. We'll take a look at the goal seek. So we're going to ask Excel, we're going to say, hey, please set this cell to what it should be, which is going to be our ending sales number, which is the 21,630. By changing, we'd like you to change this cell up top. So we're going to want to set this cell to be 21,630 by changing this cell, the one that's in yellow. And then I'm going to say okay, and it'll kind of auto-populate that. And so if that's the case, then, all right, if that's the case, this 19,753 is actually the sales that we had, and we're going to say that, the state's going to take 9.5% of it, which is going to be what we owe to the state, the 1,896.58, and that means that if we were to add those two up, it should come to our ending sales number, the 21,630. So on our books, we currently have the 21,630. We're going to back out the sales tax in this way, and that comes out to being sales should actually be the 19,753. The sales tax should be that 1,876. So what's going to happen then is when you go over here and you say, now I have to pay the sales tax. Well, when do I have to pay the sales tax? You may have to pay the sales tax monthly or quarterly, every 3 months, or yearly, depending on how much your revenue is and where your location is. Let's just pretend it was monthly, and you have to pay monthly. So that would mean that if we're talking about the month of March, this was your sales for the month of March, you'd pay the sales tax in April for the month of March. So we would run our sales report for March. We'd fill out the sales tax format, the return, which would include basically a calculation such as this. We would pay it then in April. When we pay it in April, using our cash basis system, using the bank feeds, when we do an electronic transfer, let's say in April for the sales tax, then it'll show up on the bank feeds. And when we get the bank feeds then for the check for the sales tax, what we're going to do is decrease the checking account, because it's going to be a decrease in the checking account. And the other side is going to go, we're going to put it to, instead of sales tax payable, because we're not using it, we're going to a cash basis, it's going to go directly to the sales. We'll actually decrease the sales. Or you could put it to a contra account. You can call it sales tax, contra account, like an expense account. But you could just basically decrease the sales, because the sales right now for January are overstated by the sales tax. So we can then post the sales tax to it and decrease the sales when that happens. Now, note the cash basis. What's wrong with the cash basis by doing that? It's the timing's off because I'm not matching the sales that happened in March to the sales tax that's going to reduce it that's in April. But if you look at the 2-month time period, they'll be okay. They'll be right as of the end of April. If you ran the report for March and April, then it would work out. So that's the cash basis system. It's not perfect on the matching principle. That's why the accrual system is typically preferred for financial reporting, but it's easier to do the cash system in that way, right? If you're setting up the cash system, you're going to say, well, here's the sales. Yes, it's overstated in March. It's overstated by the sales tax. We will record the sales tax, reducing the income at the point in time we pay it on a cash basis system, which if we pay monthly will be in April. So in April, we'll decrease the checking account with the bank feeds. It'll show up, decrease the checking account. The other side we're going to put to sales, decreasing sales. Yes, it will be decreasing sales for the month of April. The timing, the matching doesn't work out, but in the long run, it all basically ties out under the cash basis. It's just a short-term timing difference. So that's one way you can think about the sales tax if you have to deal with sales tax and you want to set up some kind of cash basis system. You work in the sales tax into basically the sales price, and then you can kind of back out what you owe on the sales tax on a periodic basis with a formula such as this. And then you make the sales tax, instead of reporting it to the sales tax payable, you simply, record an expense account or reduce the sales account on a cash basis as the payment clears the bank and then shows up in the bank feeds.